In this video, I'm going to go over many of the best ways that you could invest and grow your money that would easily save nearly anyone watching this tens to hundreds of thousands of dollars from taxes, and most importantly, it's completely legal with the IRS. And all I ask is that if you do find value in this content, to consider hitting the like and subscribe button for future content like this. But to get straight to it, the first area that you have to understand is capital gains. Now, for those that don't know, a capital gain is the profit that you make when you sell an investment or asset for more than what you paid for it. This could refer to many investments that you can make, such as stocks, crypto, real estate, watches, gold, art. The list literally goes on. But what's really important to understand here is that if you buy an investment and sell it within a year of owning it for a profit, that will trigger a short-term capital gain. This means that the profit that you earned will be taxed in the same bracket as your ordinary income, which for the year of 2025, that could be from 10 to 37% depending on your income. But if you held the investment for at least one full year and then sold it for a profit, that would trigger a long-term capital gain instead. That means that the profit's going to be taxed in the long-term capital gains tax bracket, which is different, and for the year 2025, that could be anywhere from 0 to 20% depending on your income. So knowing this, let's just say that you bought $10,000 in your favorite stock and it doubled in value after a full year, so your investment went from $10,000 to $20,000. As long as you held on to the investment for at least a full year before selling it, then that means that you would trigger $10,000 toward long-term capital gains. And let's say that you are married filing jointly with a total taxable income of $115,000 combined. If you add the $10,000 long-term capital gain, that puts you in the $125,000 tax bracket. But after applying a completely legal standard deduction of $30,000 in the year of 2025, that means your $125,000 income will actually be dropped to the $95,000 tax bracket, putting you at the 0% tax bracket for long-term capital gains. All that means is for this scenario, your $10,000 profit from your investment will not be taxed at the federal level. But do know that if that were a short-term capital gain, that would be taxed at 12%, which would be $1,200 in taxes that you'd have to pay. And so the higher the gains and overall income that you have, the bigger the difference it will be, and is why the wealthiest people strictly aim to take advantage of long-term capital gains rather than short-term. But do understand that unless you are in a state with no income tax, you will have to pay state taxes on long-term capital gains. To give you a better understanding, here is an image showing state income tax rates for the year of 2024, which are the rates it would be for short-term capital gains. And then for long-term capital gains, you can see here that many are the exact same, but a few will differ slightly. But understand that as you build up your investments, unless you sell the asset or it pays a dividend, which I'll mention shortly, then you have complete control over how much you will actually trigger in capital gains. But another topic that you can currently benefit from is called tax loss harvesting, which is pretty much a way that you can reduce your capital gains by offsetting the gains with investments that have lost value, which if you end up having more losses than total gains with your investments, you could even deduct up to $3,000 per year from your ordinary income. And any losses can be carried over to future years. So to visually explain this, let's say that you first bought Apple stock for $10,000 and then it grew to $20,000 and then you decided to sell it. This would trigger a $10,000 capital gain. But let's say that you also had $10,000 of Tesla stock and it declined in value to $5,000 and you decided to sell it for a $5,000 loss. This would result in a total capital gain of $5,000 rather than $10,000 that you would pay taxes on. Besides that, the last thing I'll mention here is about dividends, because when it comes to dividends, understand that whether you reinvest them or not, they are going to be triggered toward your capital gains. But many dividends, especially from well-established US companies that meet the criteria with the IRS, are able to be considered qualified dividends. And so many companies like Apple, Microsoft, Coca-Cola, and dividend funds like SCHD have been known to pay qualified dividends. To be considered qualified, that means that you must own the stock for more than 60 days in the 121-day period that begins 60 days before the ex-dividend date. And if you don't want to rewind 10 times to understand that, just hold your investment for a long time and you'll reap long-term capital gains on your dividends. And like I mentioned earlier, depending on your taxable income, with long-term capital gains, you may very well be able to be in the 0% tax bracket. So especially for those retired with a large dividend portfolio and low income, with dividends in a taxable account that are qualified dividends, you could reap 0% taxes on the income. But something I would rather do leads me into the next section, that is to utilize Roth accounts. Now, if you didn't know, for many retirement accounts like the IRA and 401k and a few others I'll mention shortly, anytime you hear the word Roth before it, that states how the account is going to be structured as far as taxes. You see, with the Roth account, this is a tax-advantaged investment account that is structured in a way where whatever you contribute into the account, you pay taxes on that amount upfront in that tax year so that you can invest throughout the rest of your years completely tax-free, with the true benefit being that after all the years of growing your investments, your end portfolio, you will be able to withdraw everything completely tax-free once you reach the eligible age of 59.5 or above, assuming you have properly followed the rules. And because investing your money over time allows your money to compound, this means that your money will continue to get larger and larger over time, so avoiding taxes on the end after all the growth is extremely powerful. And not only that, but unlike traditional retirement accounts, with a Roth there are no RMDs, which stands for required minimum distributions, and this means that no matter what age you are never required to take money out of the account. So now that you understand the main tax structure for Roth accounts, here's a quick summary of the main ones that you may be able to greatly benefit from. The first, that is among my favorite, is the Roth IRA, which stands for Individual Retirement Account. This means that with the account, you can have complete control over the account as far as the investments you buy or sell, similar to a normal investing account, but now with the Roth benefits as far as taxes. The account is so good that you are only able to contribute up to $7,000 per year as of the year of 2025, and if you're over the age of 50, you can do an extra $1,000. And do know that in the absolute worst case scenario, you can still withdraw any amount that you contributed into the account at any time, but I highly recommend to not even think of that as an option. And the last neat thing to know about the Roth IRA is that you can roll over amounts that you have in other retirement accounts like the 401k, 403b, or even a traditional IRA, you can roll that into a Roth IRA. Although if it is a traditional account that you haven't paid taxes on, then rolling that over into a Roth, you are going to have to pay the taxes. But do know that the tax structure thereafter could be greatly beneficial for you to never have to pay taxes again. And if you do hear about an income limit with a Roth IRA, if you are a high income earner, you can do what's called a backdoor Roth IRA to still utilize this account. Now, I recently made a video discussing my Roth IRA investing plan and how I believe the best strategy is to invest into growth now throughout the years to then transition into dividends later in life when you want a completely tax-free dividend income. I highly recommend checking that video out after this, but the next type of account is the 401k, and this is an employer-sponsored retirement account where the company you work for may offer this to you and even a contribution match, which means that they would add money into your account on their behalf based on the amount that you contribute into the account. Not only is that more money from your employer, but with the account, you can also contribute up to $23,500 for the year of 2025 as the employee, and if you're over 50, you can do an extra $7,500, and if you're between 60 to 63, you can do an extra $11,250. And then if you include the contributions that could come from your employer, you may be able to contribute up to $70,000 per year if you're under 50, and if you were able to do catch-up contributions based on your age, you would be able to add that on top of it. But even though the IRA is generally considered to be easier to control on your own, many 401ks do allow you to invest in mutual funds, ETFs, and even stocks and bonds depending on your employer. So for many of you, taking advantage of the Roth IRA and Roth 401k and maxing out as much as you can will definitely give you some of the best odds to have a successful retirement. But if you can't take advantage of the 401k, you may be able to use a 403b, which is typically offered by schools and tax-exempt organizations, where the structure of this is going to be very similar to the 401k, and the contribution limits are also the same, but they are known to have a far more limited number of investment options. But if you can't use either of those accounts, you may be able to use a Roth 457b that is an account for those who work for certain state and local governments and non-government entities that are tax exempt under the IRC Section 501, which the contributions are also the same for this account, but do know that a main benefit here, if you are also able to do so, is that with the 457b, it does sit on its own island, which allows you to max out your 401k and still max out your 457b. If you can't use that, another account that you may be able to use is a TSP, which stands for Thrift Savings Plan. This is a retirement savings account that government employees, including military members, receive as a benefit. This is typically intended to supplement other retirement benefits such as federal pension or Social Security for those that are eligible. And the contribution limits for this account are also going to be the same as the 401k. But do realize that if you are using an employer-sponsored account like one of the ones I just mentioned, you may very well be limited to the investment options that you can choose from. But the last account that I'll mention here is the Solo Roth 401k, and is meant for anyone who is self-employed or owns a business or partnership with no employees apart from a spouse. And with this account, you can contribute the same amount as the 401k, and also realize that you are now both the employee and the employer. Which, don't forget, for all Roth accounts, you pay taxes up front, but after all the years of investing, you get to avoid taxes entirely. But knowing that, aside from Roth accounts, let's now go over health and education accounts that you could benefit from. The first account that you may be eligible to use is an HSA, which stands for a health savings account. But this isn't an ordinary savings account because many HSAs allow you to invest, and what's shocking is that reports have found only 13% of HSA owners use them in that way as of the year 2022. But the amazing thing here is that this is a triple tax advantaged account because you can get a tax deduction on the amount that you contribute up front in that year, and then you can invest completely tax-free and withdraw your earnings completely tax-free as long as it is for a qualified medical purpose, which the expense could even be as simple as contact lens and solutions to over-the-counter medicines and drugs. So besides medical, another account for educational purposes is a 529 plan, and although you do have to pay taxes up front, after that you can invest and have your money grow completely tax-free, and it can be withdrawn completely tax-free as long as it is for a qualified educational expense, which the expenses could include tuition, room and board, books and supplies, and many other potential costs. And understand that with these, each state has their own contribution limits, and the contributions that are put into these accounts are considered gifts. So if you exceed the standard annual amount that is $19,000 for a gift, then you are going to have to pay gift tax. Besides the 529, you could also consider a Coverdell ESA, which stands for an education savings account, but understand that what you contribute here is also not going to be tax deductible. But the investments in the account can grow tax-free and be withdrawn tax-free for qualified education expenses. And the last account I'll mention is a UGMA or UTMA account that is meant for minors that are under the legal ages, and it's going to differ based on your state. And the first $1,050 of earnings are going to be completely tax-free. Knowing that, the last area I'll briefly mention on is if you are investing into real estate. Now, real estate is one of the most known investments that you can greatly benefit from tax advantages, where the first way is from deducting expenses, where one of the most favorable ones is depreciation. So let's say that you own a rental property, the IRS would allow you to deduct depreciation on the home's value over 27.5 years. So if you own a $275,000 home, you could deduct $10,000 per year no matter what. And then another strategy that many use is called the 1031 exchange, which pretty much means that when you sell a property, instead of paying the taxes on any of the capital gains, you can avoid paying taxes completely if you use the money to reinvest that back into a new investment property. So as long as you keep reinvesting money back into a new property, you can avoid taxes entirely. And then another rule out there is called the Section 121 exclusion, which means that for any property that you own and lived in for at least 2 out of 5 years, you are able to deduct up to $250,000 if you're single or $500,000 if married from paying taxes on capital gains when you sell the property. Now, there are many other ways that you could benefit from real estate investing, but to prevent the video from being super long, I'm currently in the process of creating an entire video on this topic, so stay tuned and I'll have that video linked in the description below once it's created. So if you have any questions, feel free to drop them in the comments below. And if you want to learn how to build an investment portfolio or see any of my other free learning guides that I've created, I'll have a direct link to them in the description below. And while you're at it, if you want to start investing on a new platform or have your savings earn more interest with a high yield savings account, I'll leave some of the top options available for you in the market linked below, which depending on the one that you get started with, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.